Now, one of the sectors that's been on a tear over the last 3 to 4 months has been the real estate pack. And 8% move last week, another percent and a half move today that we're seeing on Realty. And therefore, what we've tried to do is dissect a Realty company which we had dissected 3 to 4 months back. But after a stupendous rally in the stock price from sub 400, the stock currently sits at around 704. So you've seen a very strong rally from the lows. And now where we're at is what we'll try to focus in on. It's 4,700 crore in terms of market cap. And of course, the kind of growth clip that they've guided for has been extremely strong. But there have been plenty of changes which have happened over the last 3 to 4 months. And we'll try and discuss some of those. Let's try and take a top-down view first off. MMR real estate developer owns land banks in Mumbai, especially in Thane. Part of the Raymond Group, current market cap 4,700 crore is what I just said. In terms of first project, it was launched in 2019, second in 2021. Additional projects have been launched 2023 onwards. Product list, there are 3 key verticals where you can broadly split the products. Aspirational, which is 10x under the brand 10x. Premium, which is the address by GS, and they have various projects with that, one in Sion, one in Bandra and the like. And then there's luxury, which is Invictus by GS. When you're looking at geography, it's pretty much all MMR based. Thane, Mahim, Wadala, Sion, BKC, Bandra, and now Kandivali. So broadly, that's how they are structured and placed. Projects, revenue potential, total revenue potential, GDV is 42,000 crore. They've got a land bank of around 100 acres in Thane. Under development is now 60 acres versus 6 months ago of 55 acres. And then you have upcoming projects of 40 acres within Thane, within that belt in Thane, which was earlier 45 acres. So you're starting to see development happen in Thane as well. In terms of GDV breakup, 17,000 crore of the GDV is JDA focused, which is joint development agreements. So that's the 2 modes in which they are doing developments in Bombay. One is, or in Mumbai, one is through JDA, which is joint development agreements, and the other one is through their land bank. They are leveraging on both of those to try and scale their GDV. And currently 17,000 crore is through JDAs, joint development agreements, and land bank is around 25,000 crore. In terms of upcoming projects, Mahim is, there are 2 projects coming up in Mahim, roughly 3,500 odd crore. Kandivali is the other one, around 2,000 crore there. And then there's the Thane land projects, which continuously keep coming on stream. 40 acres, I did mention that. 40 acres odd is what still resides there. Let's look at the Q1 FY27 update, because post that, the stock rallied 10%. And that was one of the reasons for the move. The Q1 FY27 business update suggested pre-sales of around 700 crore versus 306 crore same time last year. Collections of 550 crore versus 374 crore. And in terms of progress, it's the pre-sales number is 700 crore versus around 4,000 crore, which is the target guidance in terms of pre-sales for full year FY27. So still to do 3,300 crore of pre-sales for FY27. In terms of numbers, now mind you, this is demerged from the Raymond listed company, and therefore we have the profit and loss account only for 2 to 3 years, and therefore we've not given you a CAGR number. But basically the base of 565 crore FY25, thereafter the revenue has gone up to around 3,000 crore FY26. Around 1,100 crore of that has come in Q4, post the last time us analyzing this company. The second one metric is EBITDA, and that has come in at 450 crore. Again, a predominant part of that has come in Q4. Net profit is around 300 crore at this point. You've got a margin of around 15% that the company does. In terms of margin trajectory, it's inched upwards from 11% to 15% that you can see on your screen. The other piece is that Q4 margins were at 20%. The goal is to get to ROCE of 20%. We'll come to the ROCE numbers in just a bit. But you look at the balance sheet, and you've seen the book value at around 1568 crore. So this trades at roughly now 3 times book. So already scaled up in terms of the way in which valuations have worked. The borrowing number is what is crucial here. Borrowings have gone up from sub 500 crore to over 1,000 crore. The cash bank balance, though, that's maybe the better way to look at borrowing. The net borrowing number is roughly at 600 crore. and therefore the debt to equity is around 0.5 times. Excuse me for that. ROCEs have gone from 16% to 30%. We'll try and understand as to how borrowing and payouts will work, what the kind of moratorium on the borrowing is, and how that will impact ROCE numbers as well and interest costs as well. The last piece is with regard to shareholding. You've got 51% shareholding now held by the promoters. They've inched up. They are holding. FIs, DIs have been sellers in this one. 8 and 4% is what they hold currently. Public holds the balance of 38%. Valuations, it trades at a 16 times trailing 12 months, which is one of the cheapest real estate companies available out there. One of those. Debt to equity at 0.5. If I compare debt to equity along with P, maybe it's a little bit more leveraged than many of the other pairs, but broadly that's how it functions. I'll quickly touch upon cash flow as well. Cash flow is currently negative. So, and this happens in case of real estate because there's inventory build-up, there's also receivable build-up. So all of that starts to play out on the numbers, but we'll try and understand as to how and at what point do we start to see a possible positive or a flat or a zero cash flow. We'll try and understand some of these trends as well. And a lot of that will also depend on completion of the projects because that's when a bulk of the cash starts to accrue. With that in mind, let me bring on board Harmohan Sahni. He's the CEO at Raymond Realty joining us. Harmohan, great having you. It's been a while since we spoke, and congratulations on the last couple of quarters. They've been strong for you. Let me now try and get a pulse. One of the questions which came to mind was what's playing out with regard to Raymond's brand name and Raymond Realty as a brand. When you do launch a project, are you able to absorb a premium versus similar projects in the area, in the same area that you put out a launch? I'm trying to understand as to how the Raymond brand is getting leveraged.
Yeah, thank you very much, Harsh. Thank you for having me on the show. And it's always a privilege. Yeah, so all coming to your specific question on the Raymond brand, what we have seen, I mean, now it's almost 6.5, 7 years that the company has been in existence. And I've been managing the portfolio for over 5 years now. And we've done a lot of new projects. Quite a few launches have been done over the years. Some of these you covered in your initial remarks. So what we have seen is that the brand is very well accepted in the market, even though we don't have a legacy in real estate, but still the brand acceptability in terms of the trust that we have created. And also, if you look at our track record so far, apart from launching and selling projects, we have also delivered projects, quality projects, and we have delivered them well before time. And in some cases, we have delivered more than what we promised to the consumer. Now, because of this, there is a buzz in the market which has gone around that there is somebody in town who is willing to change the rules of the game in terms of real estate. And that's really, so we were new to this business, so we kind of looked at the rule book fresh and we are rewriting some of those rules. So, and coming to your specific question on premiums, we don't really look at it whether we are getting a premium or a discount. Essentially, depending on the size of the project, location of the project, there is a deep study which is done by the team. And it's not just based on one or two or three, four people's view. And based on that deep study and the insights we have on the consumer, we try and price the project. And it all depends on who the consumer is, what's the kind of amenities that we are offering. So in some cases, I've got the feedback, oh, your price is high in that market. In some cases, I've got the feedback, oh, this project is great value for us. Let's, we'll just go ahead and we won't even think about it. So it's a mixed view from the consumer. But yeah, it's very difficult to say, what the prevailing price in the market is. The market is a little opaque when it comes to those things, as you are also aware.
Right. And with regard to your three brands, right? 10X, which is aspirational versus premium versus luxury. how are trends shaping up in each of these baskets? If you can just give us a sense, because your stock obviously has done very well, but the entire industry seems to be doing very, very well. I'm trying to understand whether that trend is sustainable. I know you can't comment on stock prices, but whether that trend is sustainable and whether there's an underlying current or an undercurrent which kind of justifies the move.
So let's look at the entire playing field that we are trying to operate in. We are looking at premium going all the way just before luxury or uber luxury. Uh, so even our offering of 10x, which is primarily a two-bedroom community, is of a premium nature. Uh, we are not a very standard two-bedroom, which is just offering four walls and basic vertical transportation and all. We are actually offering a lifestyle to consumers, and our consumers are willing to pay for that lifestyle. So that's one area, and that's the 10x product which we are operating in. So far, we have seen great success in that product. We had our first project was that 10x Habitat in Thana, and that project saw great traction. There were about 3,100 units. We are close to now almost 99.8% of sales. Maybe 3 or 4 units remain in that project. Everything else is sold out, and we are just finishing the delivery of the last few towers as I speak. So we will be walking out of that project by end of March in that sense. So before the project gets fully over, it's 100% sold, delivered. Part A very large part, almost 70% of the project is already delivered. People are staying there, experiencing the product. So that's one. The other one was 10x. 10x era we did. That was also in Thana. There also great success. Almost 70%, 80% of the stock we introduced into the market is gone. Very few apartments remain, and we are not even halfway done with the project. And then we recently, last year, we launched another 10x District 9. There also, whatever inventory we launched, we've seen, I mean, we haven't even dug a full hole yet over there, but almost 25% to 30% of the inventory that we introduced in the market is already spoken for. And that's very encouraging. And it's a deep market, but it's a bit of a price sensitive market, because here most of the people are salaried, they take a loan, and so on and so forth. So their monthly cash flows are important for them. Then let's look at our second product, which is the largest part of our portfolio. And that has given us the maximum success, which is Address by GS, which is a notch above 10x in terms of sizing, because it's a 3 bedroom and 4 bedroom community. While in terms of amenities and the living experience is not very different between the two, because we are offering very high amenities in 10x product as well. The density will be lower, of course, in Address by GS, and as a result, the living experience changes to some extent. Now, that's something we did in Thane. Then we did that in Bandra East, and in Sion also we have introduced an Address by GS. The Vadala project, which we launched in Q4 last year, is also an Address by GS. I mean, stupendous success. I mean, way beyond our imagination, and it's our best performing product so far. So clearly, to us, that's the deepest end of the market, and it responds very well to the offering that we have put in front of them. And obviously, it's also an equation of the brand and the trust that we command, that all that we are promising will get delivered on time or before time. And the last one is Invictus by GS. Invictus is more of a niche product where, holding back supply is the key, because their exclusivity is what we are playing on. These are very large apartments, close to 4,000 square feet or above in Thana. And if you come to the city, then they may be smaller, but the ticket size would be larger. Ticket size will be closer to 15, 20 crores, or, but just short of not going beyond 25 crores or so. So we don't want to get into a very large. So in BKC, what we have launched, that is an Invictus project in Bandra East. And going forward, also, we will be launching one more Invictus outside of Thane and Bandra East, which will be in Mahim. One product is going to be Invictus, and the second product is going to be addressed by GS in Mahim. These are our two upcoming launches. One Mahim will be launched in Q3, and the second Mahim is going to be launched in Q4 of this year. And yeah, so that's really how the portfolio has played out.
Right. I'm trying to therefore tilt towards the fact that you're obviously preferring Address and Invictus more from a scale perspective going forward, right? That seems to be the way in which you've kind of given that longish kind of answer.
So yes and no. See, each of the 10x projects which are there are very large projects. So in terms of inventory, but there are more number of projects for address in play because there are smaller projects. They are not as large because there the inventory cannot be 2,000 units or 1,000 units or 3,000 units. So in terms of inventory introduction, I think there is equal weightage to all of them if you look at number of units. But if you look at number of projects, yes, addressed by GS will score over there. There'll be more addressed by GS, but they are smaller projects.
I get your point. And Harmohan, also keen to understand, as you kind of scale, leverage will obviously go up. How do you balance between leverage and execution? Because your P&L may not fully reflect the full strength of what you're doing, only maybe for another year or two, right? Is that the right way to think of it? And therefore, how will the balance sheet really take shape?
Okay, so let's look at. I mean, I'll take a step back a little bit. Go back to, let's say, 21, 22, when really this business took off in that sense. It started in 2019, but it took off in, let's say, 21. That's when more projects started coming in. The group at that point in time kind of gave us equity of approximately 300 crores, which has been fully more than returned back to the group. The other thing the group gave us was the Thana land. So essentially, it is the Thana land which we have treated as equity, and all our expansion has been through internal accruals and partly through debt. Now, as we have scaled from outside of Thana, and we have today 7 JDAs that we have signed outside of Thana. Out of that, 4 JDAs have already been launched by Q4 of last year. Now, these are eventually obviously going to throw out cash with a lag of 3 to 4 quarters because that's how the real estate project cycle really works. 2 more projects out of the 7 will get launched this year. At after that, we'll be left with just Kandivali, which has to be launched, which will be next year that it will get launched because the approvals and the preparation of the site itself will take us that much time. And along with that, we will also be signing new projects. Now, when you're going through a growth which is like a hockey stick, and you haven't raised equity capital and you're working through internal accruals, naturally you will depend to some extent as far as debt is concerned. Now, the discipline we are maintaining and which we have continuously talked about is that we will not go beyond 1:1 debt equity as far as our balance sheet is concerned. And that is all for the growth phase. So we are not taking this debt either for expenses or for creating assets which will not give us the return. All these are 20% plus margin projects at a gross level. Minimum 20% is what we look at. Our ROC consistently has been 20% and above. I mean, I know the numbers of the division are not very well publicized in that sense, but I have access to them. If I look at the last 5.5, 6 years, our average return on capital has been around 28%, which is the best in the industry that anywhere in the country, any other real estate player has ever given. Any block of 5 year you pick up. And And I can say this with a lot of confidence because I've been tracking this industry for a quite a long time now. And so the game is really not to worry too much about debt as long as we maintain the financial discipline that we have set out for ourselves, sign good projects which, irrespective of the real estate cycle going up or going down, will continue to sell. And you have enough margin of safety in those so that, even if volume goes a little bit up or down, you can always adjust a little bit and keep the volume going. And today, debt is available to us at around 9-10%. So that's the cost of debt. Now, if my project margin is 20%, my ROC is 20% plus, and I'm taking debt in a very disciplined manner, which is one not going beyond 1:1, and it's costing me 9 to 10%. There is very little room of error that may creep in. Only if we make a grave error in judgment in terms of signing projects. But so far, out of the 7 projects, 4 are already launched, 2 are on the way to be launched this year. So that margin also keeps getting reduced as projects are launched. So that's how I see it, and internally, that's the view we have taken.
Right. And with regard to, therefore, fresh equity, that's off the table for now. Till you lever up 1:1, you're very, very comfortable with not raising funds in the form of fresh equity. Is that the right way to think of this?
So, see, apart from debt, there is another bucket also which is available to us because there are enough private equity funds which are available. There are enough AIFs which are available. We can always raise money at the project level as well. So that's another avenue available to us. So raising equity is the most expensive decision that a company will make in its lifetime. Now, so it has to be your last resort. If you're getting the growth through debt and debt in a disciplined manner, and you're getting the growth through third party capital, which you can do at project level as well. We haven't even scratched the surface there. That's one unaccessed avenue that we have. But opportunity does exist over there, and there are people who are conversing with us. So maybe we will do that first before we even think of equity. And if the time is right and we believe it is going to create shareholder value going forward, that's when we will think of equity.
Taken. And I'm also trying to get to the pre-sales numbers because they were extremely strong when you're looking at it YOY. Collections, though, not as strong. What's creating that drag? If you can kind of give us a sense. The second piece is there's a lot to be done next 3 quarters. How confident are you? This 30% growth on pre-sales versus last year, which is close to 4,000 crore of pre-sales. How confident are you of that number?
So let's try and unpack this. So you said Q1 was very strong, and I mean I don't think it was very strong or anything like that. It's just something that we do. It's a culmination of all the efforts that we have made in the last 3-4 quarters and all the launches which happened in Q4. It is just night following day. So it's not as though suddenly we did something different and strange. It's last year for first 3 quarters, I did not have enough inventory. In fact, I had more than enough demand. There were people who were waiting for our product and they were waiting for us to launch at all the locations that we had contracted. Finally, when the product hit the market, we just started seeing traction. So this is simply a byproduct of that. Usually Q1 is supposed to be the lowest as far as this industry is concerned for most of the players, including us. So we are part of that. We saw that last year. We saw that year before that, and generally that's how the industry progresses because seasonality plays a role. The families, the way they spend their time. There are kids' holidays, exams, and then the monsoon comes around Q2. So Q3 and Q4 is supposed to be better quarters, and Q1 is the lowest. Q2 marginally picks up. Typically, that's the trend we have seen by and large. So this will only be better going forward. And as far as our target for the year, you're saying, we have always maintained in the market that expect from us a minimum 20% growth, whether it is the top line in the P&L, whether it is pre-sales or whether it is the EBITDA number, you will see a minimum 20% growth from us year on year. And I can say with a fair bit of confidence that this year and next year is more or less locked in as far as that growth is concerned. So I don't see any challenge whatsoever over there as far as these numbers are concerned. Like I said, it's usually a culmination of all that you have done in the past, because all these are long gestation projects, and real estate by nature itself is a long game that you play. It's not something that you can do within the quarter that will suddenly change the game. What you are going to do 3 quarters from now, you have to start putting in the effort today. You will automatically see the result 3 quarters later.
Correct. And the piece on collections, Harmohan, if I can just cue you on that.
So collections have been on line with our expectations. Whatever we had budgeted for, we are bang on target as far as collections is concerned. See, collections again is a byproduct of what you sell versus what your milestones are. And most of these sales, almost 80-85% of these sales are construction linked sales. So as milestones start getting hit, then the collections will start happening. See, pre-sale happens, I mean, before we even dug a hole. So the best you can collect is 10% and you will register the document. And after that, rest is all going to come as your project progresses. So it's an equation of that. I don't think collections are a concern at all. They are absolutely in line with what we had projected.
This 20% growth, Harmohan, I mean, you seem very confident, very comfortable. We buy into that. Just give us a sense, how many projects get completed by end of this financial year? If you can give us a pulse of that. And does this also mean 20% margin for you, FY27, just given the fact that fixed cost absorption, etc., at lower revenue run rates was difficult, but now with that scale coming in, 20% margin, is that something we can expect?
So let's answer the first question first. As far as the projects getting completed is concerned, that is not 100% directly linked with the P&L, because we follow percentage completion method of accounting. So if there is progression in the project as it's getting completed, the P&L will keep reflecting that on a progressive basis. So the completion of the project is more to do with consumer experience and how much out of our portfolio really has gotten delivered in terms of building our track record. But still, I will answer that. So this year, we will be fully delivering the first project, 10x Habitat, 10 buildings over a period of time. We've delivered various buildings. So that will be 3,100 units will all be done. And then the first address by GS in Thana will also get fully delivered this year. Then apart from that, we will be delivering a retail project also in Thana that will also fully get delivered. So a lot of delivery happening this year as far as Thana is concerned. And outside of Thana is going to be a longer cycle, because those projects were launched recently and it's a 4-5 year cycle. They will start getting delivered 3 years from now, and so on and so forth. But P&L impact you will keep seeing as the progression happens in the project. Then your second part of the question was, just jog my memory on that.
On margins, Harmohan, very quickly, because I need to wrap.
Yeah. So as far as margins are concerned, we are given a guidance that between 17 and 19% is what you can expect from us in the current year. So it will be an improvement on our last year's FY26 margin numbers. And the reason for that is, of course, more projects are in the pipeline as far as sales is concerned. And the progress of work will also be more. The margins are also slightly better than what they were last year. So, yeah.
Right. Harmohan, thank you. You've been very, very gracious with your time. Thanks so much for coming in, giving us that lowdown with regard to what's playing out industry-wide as well as for Raymond Realty in particular.
Thank you. It's always a pleasure.
Thank you, Harmohan. And viewers, completely timed out on this edition of All About Your Company. Mind you, 20% growth will likely mean slightly higher than 20% on PAT as well. So, I mean, you can do the math with regard to EPS, but cash flow, that may take some time to kick in. That's the sense that we're getting from this conversation. Thank you so much for tuning in.